Good morning, folks. Isn't that the question we want to answer today? What's going on in the bond markets? So I'm looking at that very question this weekend, and there's a number of possible drivers that I'm considering. The most obvious one is the U.S. Fed threatening to taper or raise rates or both. I don't know what their latest story is, and I think their April-March time frame is what they're threatening. Another driver, let's see, overissuance of new debt. I mean, that's obvious. We all know what the numbers are. I think we're up 5 trillion or more that the U.S. has thrown at COVID and BBB. And then this was interesting to me. It actually didn't cross my radar back during the summer. This is the first time that the IMF has issued SDRs. Those are special drawing rights in this size. And so that's a pretty significant chunk of money, $650 billion. SDRs, it's just paper. And my understanding of how that works is the IMF, they get out the crayons and the coloring book and hey, this is an SDR, it's worth $650 billion. And then they go find some country central bank, who will exchange that crayon drawing for $650 billion of fiat currency, which of course came off the printing press as well. So fair trade, I guess, paper for paper. Chinese real estate debt challenges. I mean, that's what's really got me looking at the bond markets, the debt markets, trying to understand what's going on right now. And this is another obvious thing. We can look at the data that's available and do our best to analyze. These last two drivers, they're psychological factors. And so it's harder or impossible to judge what's going on inside the heads of human beings. But at some point, the factors that we've mentioned or we're aware of, overissuance of debt, money pumping, negative real interest rates, at some point, all of those factors, which are objective, we can measure these things, they affect the sentiment, the psychology of investors, and then markets shift. And it's not always obvious why those markets are shifting, because it's human beings. Human beings are interesting critters. And then it's another way of saying the same thing, repricing of risk, bond vigilantes. Maybe that's, I'm dating myself by using that term. The idea that they may have awoken is expressing the same idea as above, is that it's a repricing of risk for whatever reason, potentially. To continue, so if those are the possible drivers, I discount the first one immediately. I don't even have to spend any time thinking about it. I wish we didn't even have to talk about it. The Fed's not going to do that by choice. It ain't going to happen today or in March or April, but they're going to, for the next 3 months, they're going to threaten, taper or not taper, taper, not taper. We're going to get 3 months of that, and come April, March, whatever it is, the jobs report will be weak, the stock market will be soft, whatever the, latest strain of COVID, whatever the justification is, the Fed is not going to taper or raise rates by choice. So we can cross that off our list. Don't even have to talk about it. Now, as a second or follow-up thought to that, we do have to acknowledge that there is a non-trivial segment of the financial markets that knee-jerk reaction to any bloviations from the Fed. And so the markets do get pushed around by every time they threaten to taper or say, oh, now we're not going to taper, the markets react to that. But in the big picture, and that's what we're looking at here, in the big picture, we know that's not going to happen. Overissuance of debt, this is a new... Like we didn't have enough money creation, debt creation going on already with the central banks of every country on planet Earth printing up as much new money as they can for the last 2 years. Now we got the IMF throwing their hat into the ring with, $650 billion. That's a pretty big chunk of money. It looks like they are up to, as of today, they're up just over $800 billion total stimulus that they've thrown at COVID-related stuff. China, that's what we're looking at. Oh, the negative real interest rates. Now, see, this is hopefully nobody's believing the transitory inflation story anymore, and so we can actually acknowledge that inflation at this point is at least 5%. I suspect 7% is, I think the numbers, the official numbers are starting to show more like 7%. And then John Williams' shadow stats is higher than that. So, and real interest rates, if you're not aware of what that is, that's what is the inflation rate versus the readily available interest rate on bonds or debts, fixed income. And so right now, inflation is clearly higher than any coupon you can get on a bond. I mean, where can you get a bond paying 5%? You can't, much less 7%. Well, I guess maybe there's probably some junk out there. Yeah, you'd probably go buy Evergrande. You probably buy Evergrande bonds right now. They're probably paying at least 7%. Good luck with that strategy. And then I'll continue with this report. I've got some more details I want to dig into and look at. These are some of the things that I'll be continuing in my investigation. And again, most of this stuff, the first few bullet points are objective. We can go out there and it's like, okay, that's a fact. We can analyze that. There's a fact, etc. But then we get into psychological stuff where we're, contagion effect, and that's back into psychology again, which is a challenge to judge. This is interesting. The demand economy, that's when the politicians decide how much growth you're going to have in a year. That's an interesting situation. So here we are. Well, let's take a quick look at the charts. This is the 10-year yield on the 10-year note in the weekly time frame. And so we can see big impulsive high energy price bar last week. And this morning, so far, we've got a continuation of that move. And let's look here in the daily time frame. We can see that the market is trying to push higher this morning. So Friday we got price or the yield reached the upper median line of this shift pitchfork, ran out of steam and pulled back a little bit. But now this morning we can see that trend continuing. Energy is very elevated. You could say that it has rolled over, but again, this is a bounded indicator. It only goes to 100 and it looks like it's at 95, almost 96. So the energy is elevated. MACD, another one of the indicators that I like to look at when I'm trying to get a gauge of where might this price movement run out of energy. MACD is not a bounded indicator, but there tends to be somewhat of a bounding effect where prior highs and lows in the MACD indicator will act as a bound or a range limiter for subsequent moves. And so if we look at that effect here, we can see here's the last peak in MACD, and that was that rally there. MACD peaked at that point. And we can see that MACD is pushing up into that same level. No real indications that it's rolling over yet. And again, this is not a bounded indicator, so MACD does not have to stop there. It can go to infinity on this move if it wants to. So let's see. That's interest rates. We'll be looking at those more this week. Let's see. Gold, not happy camper this morning, reacting to interest rates again, and I would point out, when we're looking at gold, is it weak, is it strong? Let's consider two factors. Well, the dollar has done this in 2021, and interest rates have done this in 2021. So in light of those two markets, Gold is actually holding up rather well, in my opinion. Seems to be kind of set on hanging on to that 1800 level. Let's keep rolling. This is silver in the daily time frame. It's a little bit more perky than gold this morning. It's actually risen instead of fallen. Possible that we got a stronger support level. We zoom in, we can see that we perhaps have a confluence of support between the median lines of those two forks. MACD still on a sell signal, energy very low. The mining stocks, they're going to follow the metals. Energy's low, MACD in bear mode. Looks like we're going to have a soft open based on the pre-markets. This is Bitcoin having another down day. I just, was curious, when did Bitcoin ETFs become available? And so it was October 19, that was of 2021. That was the first Bitcoin ETF that became available. And as sad as it is to acknowledge, folks, there is a behavior that occurs in Wall Street where when they have pushed a trend as far as it can go, they unload their long positions to the retail investor and then they bail. And so they bail on their long positions and may even reverse and go short. And so I'm not by any means suggesting that that is what has occurred in Bitcoin. I'm merely pointing out that on October 19, the first Bitcoin ETF came on the scene, and that market is down, I think as of yesterday, it was 35% or so, and now we're dropping some more. So anyway, Wall Street, gotta love them. A US dollar sideways bumping, looks like it's strong today. Green bar there, so gold's got that as a headwind today. We've already looked at interest rates. The equity markets aren't open yet. Friday, we found support on the 50-day moving average. Energy declining, MACD on a sell signal, but still in bull mode, suggesting that the primary trend is up in this market in this time frame. Support on the 50-day, if price wanted to make another run higher, that's a good potential support level to do it from. We'll have to see. Dow, pullback continue, perhaps found support on the 20-day moving average on Friday. We'll see what it does today. Nasdaq, again, responding to interest rates. That's a headwind for the tech stocks. Typically playing with this support resistance level. Didn't do very well maintaining it Friday. Sell signal, energy declining. Folks, that's all I got this morning. Markets are about to open. I will talk to you soon.